First of all, thank you very much, everyone. Assalamu alaikum. It's an honor to be here. And I'm Navin Gupta, and thank you very much for introducing me. But my sole job in the next 15 minutes is to make these 15 minutes valuable for you, right? If it's not valuable, then Navin Gupta doesn't matter, right? So I'll do my best. And I'll take up something, a little bit of a difficult topic, and it could be a little bit controversial as well, in terms of looking at blockchain-based remittances, which is what Ripple specializes in, as a key lever for both financial inclusion and globalization, right? Generally, what you would find is financial inclusion and globalization are considered to be contrary to each other, right? On one hand, there's wide swaths of people where the economy is globalizing, which are coming into the mainstream, but at the same time, constantly, all of us feel that there's still very large amount of population which has been left out, which is not included in the financial system. And this is something His Excellency, Mr. Amiri referred to as well, financial inclusion being a key pillar for the Central Bank of Oman going forward as well, right? I'm not using any slides so that you can focus on what I'm saying, because we are not able to do two things at the same time. So hopefully that works for everyone, yeah. So let's talk about globalization in general, right? So a globalization has essentially three legs. There was something that happened about 70 years ago that made globalization of goods possible, and that was something very humble. Let me give you an example so that you're able to visualize what I'm talking about. Let's assume there was a furniture manufacturer here in Muscat, and he wanted to sell something to a client in Germany, in Hamburg. What would happen is they would essentially take their goods. The furniture manufacturer will take their goods. They will pack it in a truck. It will go to a port. It'll be unpacked in that port. It'll be repacked according to the ship that was carrying that goods to Hamburg. In Hamburg, it'll be taken off, unpacked again. It'll be repacked into the trucks that the German transportation would carry, and then it will reach the buyer in Germany, and then the goods will get paid. But there is something happened very significant about 70 years ago that changed the way the goods get transported. Can anybody guess what it was? Sorry? Container. Absolutely brilliant, right? So today what you see is essentially you have a container that sits in the furniture manufacturer. He packs the goods in a 20 feet or a 40 feet container. All the trucks that carry that container from say, for example, from Muscat to the port are meant to carry that container. It goes in a ship which has got cranes, which just lifts the container and puts it up there, and it goes to Hamburg. And most of the time the goods reach safely. Before that, 30 to 40% of the goods get damaged just in transit itself. That means globalization was not possible because the friction was very high in terms of the movement of the goods. And the global trade exploded after containers came into being, and actually it's a humble container that made globalization of goods possible, right? The same thing happened in terms of data. What made globalization of information possible? The way we are able to send emails to each other, we are able to read website, we are able to know any information from any part of the world. I mean, I think this is very easy. Everybody will be able to tell that. What made the globalization of data possible? It's the humble internet, right? That we use all the time. We have a phone in our pocket, and we are able to access every information, every ticket, every hotel, whomever you want to, through this data. But there is a third leg of globalization that we feel is missing today, right? Which has not really happened. It's the globalization of money. That means if you needed to move money from place A to place B, it still takes 2 days. It takes sometimes 5 days. Sometimes your money gets lost in the middle when it's moving cross-border, right? You have no idea when it has reached the other person. And a lot of time we don't have the transparency. So for example, lots of you, when you want to send a wire transfer overseas, you would not know how much will it cost before it gets delivered to the final beneficiary in the currency that the beneficiary is expecting. So let's assume, let me ask you a very simple question. How many of you, there's a bottle of water on everybody's desk, right, on everybody's table. How many of you will go to a supermarket and buy this bottle of water without knowing what the price of the water bottle would be? How many of you will do that? Right? Most of us would not, right? Because we want to know what the price of the water bottle is before buying it in the supermarket. But today that doesn't happen in the wire transfer. You essentially send your Omani Riyal. You don't know how many Kenyan shilling will the person get it in Kenya if you're trying to pay a supplier, right? It's only after the fact After 1 day or 2 days, of course, you will have your debit in the Omani Riyal, but you would not know how many Kenyan shilling will get delivered on the other side. It may take 3 to 5 days. Sometime it gets lost. This is Swift's own published error rates. Between 4 to 6% of the transactions need some kind of a manual help or have some kind of an error which needs to be fixed before money gets delivered on the other side, right? So to my mind, it is exactly the same in terms of the friction, in terms of the error rates, in terms of the difficulty that is holding back the globalization, the third leg of globalization, that means transfer of money. And that's what Ripple is here to solve. We are not here to make small changes to the existing technology, but we are here to make a dent in the universe by making sure that money is able to move exactly the way an email moves today. That you should instantly be able to transfer your own legal money, which is fully KYC'd, which is fully regulated, which meets all the AML and the compliance standards set by the regulator in your country, but it should be delivered instantly on the other side, almost like what happens in WhatsApp. And if you look at today's generation, that's what they're used to. They're used to instant gratification. People are not looking to wait for days, hours, error rates for money to be delivered on the other side. So let's look at it. How does it impact us? How does it impact financial inclusion? So let's first just look at individuals, particularly in the GCC countries. We are very aware that there is a large expat population from different parts of the world who essentially comes and works here. And when they send money back home, this money is important because it pays the school fees, it pays the medical bills, it pays the household income for those particular families. And if we are able to transfer money to them in real time, in a way it is transparent. That means they're able to see what FX rate will get applied, what fee will get applied, how much money in the local currency will get delivered on the other side. Then we are providing them with a better customer experience, right? We all know that this is the World Bank reported data. Remittance cost about 7 to 9% in terms of 7 to 8% in terms of the fee that gets taken out for an average $200 remittance that essentially goes overseas. And this is a stated goal for all regulators, all policy experts to essentially see how we can reduce the cost of remittances. But the cost of remittances cannot go down if we can't have error-free service. Because today, I used to work with Andrew Long a few years ago when he used to be the COO of HSBC in Asia, and his simple mantra to me was, I want STP. If something needs to be touched by a human, a transaction in a bank needs to be touched by a human, then that would create cost for the bank, and that cost will need to be borne by somebody. But if we are able to have STP transactions, then essentially it goes through, right? So this we are talking about individuals. Let's look at e-commerce firms. So today, there could be a business in Oman who could essentially decide to sell fashion accessories online, beads online, some construction material online. But unless they're able to collect instantly without the loss of value from anywhere in the world, we are essentially creating a barrier for them not to be able to sell globally, right? Now let's look at some businesses in terms of their working capital cycle. So let's take an example. There is an Omani supplier. It's selling goods all over the world. And on an average, they get paid in 30 days. So they have a 30-day terms, which is essentially standard terms in number of industries around the world. But today, even though the terms are 30 days, the buyer sends the money in 30 days. They only receive the money T+2. That means in the 32 or 33 days. That means if they were to receive money instantly, let's assume they're working with a Kuwaiti buyer, they're working with a KSA buyer. If they're able to receive the money instantly, then you have added 1 month worth of working capital cycle in the whole year. That means those 2 or 3 days combined into 12-day cycle essentially gives you 36 days of extra money that's working capital that's available to him. That means either he needs to borrow less, or he can essentially increase his sale by 10% by causing the turnover in the money. And this is a very humble concept which is sometimes misunderstood. By increasing the velocity of money, we can just have an increase in GDP without actually lending more, without actually creating additional capital in the system. So just by making sure that there is greater electronification, there is instant delivery of money on both the sides, we're able to get higher growth rates. And there are McKinsey studies out there, and hence you would see policy experts around the world going for electronification, both for domestic payment systems and cross-border payment systems, because you're able to have a positive effect on the GDP just by increasing the pace at which the money gets transferred between cross-borders, right? Now here I talked about some of the very basic things you're probably already aware of, but a lot of things that we're not aware of is the future business models, right? So let's take a few examples. Today, what happens is their information is available to everybody. That means small businesses are able to sell online, on demand, whenever they would want to. Let's take an example of tourism sector in Oman. I'm just taking a very simple example, but there could be tens of other examples, right? As the tourism sector in Oman essentially grows, every payment, every small amount of money for hotel booking or for anything else that they receive from, say, GCC countries, which they want to target to, they would lose between 3 to 5% of value. But we are already working in a number of other countries where you're able to use a very simple, for example, a QR code from another country, a traveler or a passenger from another country, who's able to use their QR code and instantly be able to trigger a cross-border wire transfer from account in KSA, from account in Kuwait, from an account in any country around the world, and to be able to deposit that money in Omani Riyal for that supplier for the service that is getting sold. Now, these are new models that will emerge on the plumbing that Ripple is working with banks on. The top banks in KSA are our customers, top Kuwaiti banks are our customers. And we are thinking, how do we reimagine the cross-border experience that essentially the people in the room here have, and to be able to reduce the friction to the minimum, but also at the same time giving the benefit of that plumbing to the banks. So we are not looking at becoming a distributor ourselves, reaching out to the individuals ourselves, but letting the institutions, because the institutions are compliant with the KYC norms, they are most familiar with the AML norms, and within that compliance framework itself, provide the benefits of that plumbing over to the customers in that country. And these customers could be corporates, these customers could be individuals, or these customers could be the financial institutions on a wholesale basis who deal with other corporates. The easiest way for you to visualize what I'm talking about is, let's assume you're an institution. Today, you can go on Amazon and essentially decide, or any shopping comparison site, and then you can decide to essentially say, let's assume I wanted to buy this jacket. What is the price of this jacket across 5 different suppliers, right? And you're able to choose, hey, supplier A, supplier B, supplier C, what kind of quality they offer, what kind of price they offer, and do I want to use this supplier or not? You'll be able to get some feedback as well. At some point, what we visualize is something that we call internally as pathfinding, which means even for your overseas remittance, what a bank will be able to see is, it'll be able to see, yeah, you know what, if I'm able to send this transaction via bank A in the UAE, it'll cost me this much, and it'll get delivered in 1 hour. If I send it through US dollar, it'll get delivered in, say, X amount of time, it'll cost me that much, and it'll essentially be error-free. And then they will be able to, like a shopping comparison website, will be able to get 5 options, and they will be able to choose where they essentially want, which mechanism they want to use to essentially send money. If they want, they're also able to expose exactly these 5 options to their customers, who are able to say, if I send the money, it takes 2 days, I pay, say, maybe 1 Omani Riyal. If I want to send instantly, I pay 2 Omani Riyals, right? So almost like a shopping comparison website, you're essentially able to go and offer those options to your customers, because today you have that information available to you that depending upon the path that you're going to follow and the transaction is going to get delivered. So to our mind, this is what creates financial inclusion. Whenever we offer customers the choice, whenever we remove errors, we remove friction within the plumbing of the financial system, it creates inclusion, because it lowers the barrier for a lot of people to be able to shop and sell their goods online, to be able to collect money from their customers at a much cheaper price, even if it is cross-border or if it is domestic. And almost we make the flow of money exactly like email or information moves today, right? And this is, to our mind, quite critical for any economy, for the GDP to increase, and large swaths of people who essentially want to become entrepreneurs, who are SMEs, who want to start modern businesses, to be able to outreach and to be able to build businesses which are essentially future-proof. Now, let me just take 2 minutes to explain to you how Ripple helps with that. So easiest way to think about Ripple would be, it's like WhatsApp, right? Bank A has WhatsApp, Bank B has WhatsApp. What they do is they would download a software on both the sides. The software sits behind the firewall of banks. That means essentially it's not in a cloud, it's not available publicly, it cannot be tampered by anybody. Let's assume a customer of bank A wants to send money to a customer of bank B. The first thing that happens is validation happens. That means bank B confirms whether the account name is correct, account number is correct, what is the fee that will get applied to this transaction, and how much money exactly in the local currency bank B will promise to deliver in case bank A was to go ahead with this transaction. Let's assume the transaction was for 100 Omani Riyal. Bank B also confirms that they have done all their AML checks. That means if this transaction was to come through, this transaction will go through error-free. If, let's assume, for some reason there was an AML hit, then they will be able to say, hey, I need a passport copy, or I need the date of birth to clear the transaction. And all that can happen before the customer accounts gets debited. Let's assume this validation gets completed. Then there is an instant debit and an instant credit on the other side. That means bank A's customer account gets debited and bank B's customer account gets credited. In 100% of the cases, there will never be a case where there is no credit, but there is a debit that has happened. If the credit has not happened for whatever reason, the debit will also reverse itself, right? And this is all enterprise ready. The data leaves bank A's backend encrypted, and it's only decrypted behind the firewalls of bank B. There is no storage of data. It can't be decrypted within flight. It's latest cryptographic technology is essentially used for this transmission to happen. And that's what creates a great safety net between two institutions in a peer-to-peer connection to be able to interact with each other. A lot of time, this is also very misunderstood. This is not a public blockchain. There is no use of crypto tokens. But what we have done is, for the enterprise, to make this possible, we have taken some elements of blockchain technology. That means cryptography, because as if you think about blockchain, the main thing behind blockchain is the security element. And we have taken that and incorporated it so that customers and the businesses are able to get the benefit of a safe and secure medium between the two institutions. It's a peer-to-peer connection. That means it doesn't go via a third party, it doesn't go via a hub and a storage model, because what we have seen is hub and storage model that was created 70 years ago are prone to hackers. So we have had a number of instances around the banking system in the world where infrastructure has been hacked, and there have been problems where people have been able to get in because it was not a peer-to-peer connection. So we heard the voices of the banking sector to say they didn't want they didn't want public blockchain, they didn't want their data to be revealed, they don't want to use any crypto token, and we have taken the elements of blockchain which are enterprise ready, which are approved by the regulators around the world. And when I say approved is there are banks live in KSA, there are banks live in Kuwait, there are banks live in UAE, there are banks live in US, there's banks live in UK, Santander, Standard Chartered, you name it. And they are using it as at an enterprise level to essentially bring these benefits to their customers of error-free cross-border transactions, instant cross-border transactions with transparent fee, FX, and idea behind almost like a comparison shopping in international remittances itself. And as institution compete using latest technology, the customers, both it may be corporate or individual customers, benefit from these technology. I'll just do a quick time check in terms of how I am, and then anybody with time check? Am I still good for a couple of minutes? 2 minutes? Perfect. So I'll wrap up in terms of the next couple of minutes. So if you look at the three legs of globalization, container did the first thing, internet did the second, and Ripple, along with a number of other institutions, we are doing the third thing. We are live with about 200 institutions. We are working in production with about 200 institutions around the world. About 70 corridors are live today. That means it's available at scale with very significant amount of volume flowing from institutions and countries from one place to another. And we are serving our customers, and the idea is to give a great customer experience to the customers of the institutions that we are serving. So we are very thankful to be here in Oman, and I look forward to working with the banks here, financial institutions here, regulators here, to bring the Ripple experience and the Ripple technology to the institutions. Thank you very much, everyone.